this. How many of you guys have read the appendix chapter, which shouldn't be an appendix, it should really be a chapter, it's packed with stuff. We got 1, 2, that's pretty good. We only had 2 in the other group, and they were a larger group. So, yeah, well, the rest of you need to get with it, right? I know we just did it with everything. But why did you do so well on this quiz? You jumped right in and went after it right at the beginning, am I right? Pounded on it, worked through the practice quiz, looked at those boring review things, or came to one of those boring reviews, right? Paid attention in class. So get it read by Monday, okay? This is a really tough chapter. It's not really so difficult intellectually, I guess. It's just there's a lot in there, okay? A lot of different things in there. What's that?
It's kind of complicated.
It seems complicated, doesn't it? It really does, but it's really hard to write down. It's easier to say out loud, so I'll say it out loud for you, show you how to do it, okay? And we'll do it in the review session too. So we've got 2 days on this chapter. I gave 2 days to these last 2 chapters because they're hard, right? There's a lot there. And you guys didn't think bonds were hard, I guess, but did you when you were working on it? Before you started doing it, it looked kind of like, oh my God. And then you started doing it, and by the time you did the quiz, what happened? Big deal, huh? Just be careful, right? Be meticulous about it. Don't assume a full year when it's half a year. Is that what you did?
Probably.
I think so. And I think you got interest for a full year. So you still didn't cost very many points because you know you could. Okay. Anyway, so let's give this a shot. This is just not very bad, you guys. It's not going to be a very big deal. We have investments in other companies. So what do you think? An investment in some other company is what to me? If I buy their stock, what is it to me? It's an asset. That's it, right? What is it to them? It's their equity, right? Of course. But it's going to be an asset for me. So how am I going to increase the account, no matter what I call it? With the debit. Debit and investment accounts. Right? Always going to be. What if I sell it? Credit. Big deal. Okay. Everybody agree with that? By the way, you guys know how to handle investment held to maturity bonds? Yes, we already did it, didn't we? So if I buy all the bonds of a company, not all the bonds, if I buy bonds of a company and I'm going to hold it to maturity, right? I'm going to hold it to the end of the term, right, of the bond. I call it investment held to maturity. I have a discounted premium. I amortize the discounted premium. You guys already know how to do that, don't you? That's the investment side. Okay? Well, what if I'm going to hold it for just a short period of time? Well, now it's not an investment held to maturity, of course. It's going to be a trading security bill, but it's so short-term or that it's so long-term. Oh, no. Nah, it's going to be that. It's really not. But I have no control, so it's going to be in those categories. All right? What if I own preferred stock of a company? I have no control if there's no voting power, right? Usually preferred stock doesn't vote. So what do you think? It's going to be in the same categories. Ah, this isn't going to be too bad. What if it's common stock? Now it's going to depend on how much I own, okay? And by the way, those 3 categories that I talked about, trading security available to sell short-term and long-term, all of those are really just dependent on how long you're going to hold the investment. So it's all going to make sense, okay? So if you get this organized, it looks really complicated, he's right. It just seems, oh man, what's going on? There's all these different things and all these different options. I can never remember all of this. That's true. I don't see how anybody could possibly remember this when they first look at it. I don't know how you can remember it ever. It's just way too much. But could you figure it out? Like everything. Yes. Do you guys have memorized how to do bonds? Or do you know how to do bonds? And what's the difference there? I don't know. It's real close, isn't it? I can remember it because I know what I'm doing, right? But if I just try to remember it, not knowing what I'm doing, I'm dead meat, right? It just collapses on me. It's going to be the same way. So is cash flow. It's going to be the same way. It's just logical, simple stuff, but it's going to be the same way. Okay? The cash flow chapter we still have left to do. So we got 2 tough ones. And then financial analysis isn't too bad. The other chapter. The other 3 chapters. Can you believe that? Isn't that cool? Never thought we'd get here, right? How many are we doing? 15? 14 chapters. Counting the appendix. Okay, so here's what we want to worry about. How long? I wait too There it goes. All right. How long am I going to hold it? It's one category, right? How long am I going to hold it? Investment. Okay. And how much do I own? Which is what percent do I own? Okay. Okay, let's do how much first. How much is going to determine how much control I have? Okay, can you read this chapter? Okay. How much control we have, right, guys? Right. Okay. So, you remember the categories? One was
medium to large.
Well, kind of. Only they talked about how much control we have. So if it was a small investment, I would have
Be below 20%.
below 20%. So between one share, now this is only going to be, you're only going to worry about it for common stock, right? With preferred stock or with bonds, you have no control anyway because you don't vote, right? So this is just for common stock, voting common stock. One share through 20%, and 20% is just a rule of thumb. We're going to say in that area we have no control. Because when the shareholders vote, I lose, right? I can't control it. I don't help run the company. Does that make sense? Everybody good? And 20% is just arbitrary. If you know what? If you own 19% of General Motors, you would be on the board of directors and you would certainly have significant influence. It would not be no control. If you owned 21% of Ford Motor Company, right? And you're on you might be on the board of directors, but even then you wouldn't have a lot of control because the family still owns a majority share. Through their descendants. So it depends on what the company looks like. Ford's a real big company, but you need a really big chunk to have significant influence, okay? In a company like General Motors, where it's widely held, I don't think anybody owns more than 1% of it. Got the idea? So you'd be pretty important if you own 2 or 3, okay? So this is a rule of thumb. It's for judgment. For our purposes, I'll give you that they own 1,000 shares out of 1,000,000 or something. How much control do you think they have? I mean, me personally, I own a whole bunch of stock, you guys. Not really. I own a whole bunch of shares, a couple of each different company, right? It's called a diversified portfolio. I don't own very many shares of anything. I bet I own some Papa John's. I don't even know what I own. Some mutual funds. I bet I own some Papa John's and some Yum. What if I called up either one of those places and told them what I thought they should do? They'd think I was crazy. Nobody's even going to talk to me but a secretary, right? I'm never going to make it to Papa John himself. Yeah, okay, anyway. Anyway, so, no control, huh? When they vote, I have no say. All right, so then what's the next category?
Medium.
So 20%, above 20%, rule of thumb again, through
49, 50.
Yeah, up to 50, just less than 50%, okay, up to 50%. Here we say we have significant influence because we do. We help run the company. Does that make sense? That's the theory of it, okay? So all of a sudden, this stuff, when you read it, looks like, oh man, this is really hard. But it just makes sense, okay? I have significant influence. If I'm between 20 and 50%, I'm probably on the board. I'm helping run the company. And here's the deal. If I have no control, I just take what the market gives me. If they pay dividends, that's nice. I got dividends. The stock value goes up, that's great. If stock value goes down, I feel bad, right? But I'm not making anything happen, right? I'm just taking what the market gives me. Everybody got the idea? Okay, in this case, what's the deal? I'm helping make it happen, okay? Because I have significant influence. That's the theory on this. And the 20% is arbitrary, isn't it? Okay? All right. So then what? Guess what the other category is? Control, which is what? Anything over 50%. One share over 50%, what happens when we vote? I win. I like democracies like that one, right? That's what all the folks in the debate the other night want, you know. They want to have a total control. It's called a dictatorship. I'm sorry, you guys, we're not doing that, right? It's democracy. You have to compromise with the other side, whether you like it or not, right? Okay, multiple viewpoints, lots of viewpoints. So 50% to what? 100%. I have control. When we vote, I win. We're going to say that other company doesn't really exist. I do. I own them. Okay, I have control of them. All right. Okay, so what we call this is control. That's simple. So the small ones, no control. The medium-sized ones, significant influence. The large ones, total control. Yes, sir.
Why would a company allow someone to buy 100% of like their stocks and everything?
Well, you might start the company and issue the stocks yourself. They don't have a say. Or you might just go out and you might offer the shareholders that exist. The company doesn't get to have a say on it. The shareholders do. The shareholders own the company. So if I convince all the shareholders to sell me their stock, guess what? I own it. All you have to have is more than 50% to control it, though. So the people who, let's say you own 60%. The other 40%, we're going to call those minority shareholders. Would you be willing to be a minority shareholder in a company? Yeah, if they do a really good job running the company and you don't want to run the company. Who cares? I'm a minority shareholder in everything I own. I don't run any of them. I don't want to run any of them. But I want them to make me richer, right? I want them to make good investments in assets, people, and so on, right? Make good decisions. Right? Do good things for the community, too. I like that, too. Right? But I want them to make me richer, don't I? That's what it's about, okay? So I can invest in all sorts of things. Now, if you want to have control, of course, what do you have to do? Buy enough stock to run the place, right? Okay, that makes sense? But that's true if you're just in the parent company. How do you have control of the parent company as an individual? Own more than 50% of it. How many companies are controlled by one person? Only little ones, right? Big ones aren't controlled by one person. You don't have enough capital, enough wealth to do it, okay? There might be a small group of people. Okay, anyway, so those are the categories, huh? And then when we do how long, the how long only applies to the no control situation. Only that one. All right? So this is going to be pretty easy. These, we don't worry about how long. Oh, by the way, if I own 40% of the stock, do you think I'm going to sell it real soon?
No.
No, it's going to be a long-term investment. What happens if I own 40% of the stock and I flood the market with that stock? Put it out there for people to buy. The bottom's going to fall and the price is going to lose a fortune. You can't do that, right? So you're going to hold it long-term. What you'd have to do is arrange for people to buy it from you, arrange a deal for them to buy it from you. That makes sense? Certainly if I own more than 50%, that's true. What if I own 1% of the stock and I want to sell it? Probably sell it. What about 1/10 of 1%? They might not even notice you sold yours. Got the idea? Okay? So, totally different environment here. We're going to have something.
So isn't the no control considered a current asset, or that you would just consider?
Well, no, that's the how long. These are non-current. Both of these would be non-current assets, wouldn't they? Because you're going to hold it for more than a year. Could you own less than 20% though and hold it long-term?
So it could be
Yeah,
both.
if you intend to, it could be both. Very good. Okay? So what we're going to have is three categories here. We're going to have something called trading securities. Trading securities. We're going to have available for sale. Short term. And we're going to have available for sale. Long term. And we are going to account for each of these, maybe unfortunately, a little bit differently, okay? So it makes it a little more complex. So we are going to have 1, 2, 3, 4, 5 accounts that we're going to have to mess with investments here, okay? So far. Besides the held to maturity, right? Bonds. In addition to held to maturity bonds. What we're going to call them here, if I have significant influence. Oh, by the way, it's going to be an investment in a trading security, investment available for sale short term, investment available for sale long term. So it'd be investment in, okay? It's an asset. This would be on the 20 to 50%. It'd be an investment in an affiliate, an affiliated company. So yeah, investment in affiliate. So investment in affiliate XYZ company, right? Whatever their name is. Got the idea? Okay. Long-term investment. So that's the only one here. Okay. Over here, it's going to be an investment in a subsidiary. Got it? So how many accounts do I have I'm messing with? 5. Okay. but they kind of make sense, huh? Okay. Why is it an affiliate? Because I have significant influence. I'm an affiliated company. Why is it a subsidiary? Because I'm the parent. They're the subsidiary. I own them. I control them. Got the idea? Or at least I own over 50% of them. Everybody good? All right. So, what percentage ownership, or I'm sorry, the percentage ownership is less than 20% here on all three of these. How long? Let's do the how long. How long are we going to hold trading securities? One day through a few weeks. Very short term. Short-term asset on the balance sheet, right? Very short term. One day through a few weeks. You got it? Okay, so it's a trading security. It's ready to trade. Trading security, not a bad name for it, you're supposed. Investment in trading securities. You might have a lot of different companies that own stock. You got the idea? By the way, that could be bonds too. Right? These over in this category, it could be stocks, bonds, preferred stock, common stock, preferred stock, bonds. Okay? How about a bill for sale? That's trading security. How about a bill for sale? More than a few weeks, up to what?
4 months. Up to a year.
1 year. That's the definition of short term, isn't it? Up to 1 year. Everybody got it? That's logical, isn't it? It's available for sale. I'd sell it. I plan to sell it within the year, right? Everybody good? And then we got a category called avail for sale long term. Guess what it is? Over 1 year. So when you look at the problems I'm going to give you, what do? Ask yourself, how much do I own? If it's less than 20%, where am I? It's either a trading security avail for sale short term, avail for sale long term, right? What if I own between 20 and 50%? It's an investment in affiliate. What if I own more than 50%? It's an investment in a subsidiary. All of a sudden, this complexity goes away, doesn't it? So what's the first thing you want to know? What percent do I own? Okay? Then what do you know? If it is less than 20%, what do you want to know? How long do I intend to hold it? And this is the decision the company makes. How long is my intention of holding it? Okay? So what's the deal, everybody? It could be a trading security if I intend to hold it what? Less than a few weeks. It could be avail for sale short term if I intend to hold it more than a few weeks, but up to 1 year. It could be an avail for sale long term rather, if I'm going to hold it for longer than 1 year. And what kind of investments are going to be in there? Common stock, where I own less than 20%. Any amount of preferred stock, any amount of bonds, where I'm not holding the bond to maturity. You already know how to hold bonds to maturity, right? Record the discounted premium and amortize it, right? Everybody good? Okay. So, excuse me. Let's do the recording, right? This is the idea. Let's record some transactions here, okay? Buy them and see what the journal entries look like for a year. What do we buy all these investments with? Cash. It's pretty simple, right? You're going to credit cash no matter what it is. And then you're going to debit investment in trading security, avail for sale short term, avail for sale long term, investment in affiliate, or investment in subsidiary. Okay, it's going to be something like that, right? Now the methods we're going to use for accounting for these, need to get those ideas too. What method are we going to use to account for each of these? Because we don't have any control here, we are going to use the market value method. And what that means is I am going to adjust the investment from the historical cost that I bought it at. At the end of the year, I'm going to adjust it to market value. So let's think about this. If I own a share of stock in General Electric, do I know what it's worth at the end of the year? Yeah. We can find out what General Electric stock was selling for 30 minutes ago by calling it up on Yahoo Finance or MS Finance or any of them, right? We can look it up. You can, for free, find out what things were selling for 30 minutes ago. I can do it on my phone. You guys want to know what they were selling? I don't care. Oh, my phone's in my coat. Anyway, right? My wife buys me 2 nicer phones, so I'm terrified I'm going to lose it all the time. I really have days when the phone costs $20. You know, if it loses, just get another one. Apple thing. It's so I can see my grandkids' pictures, though. That's what it's for. So nobody ever calls it. Well, sometimes you guys do, but I ignore you, don't I? Yeah, good point. Yeah, that's because I have the buzzer turned off. Because you know I'm in class, so I should turn it off. Because it'd be rude if I had it on, then I forget to turn it back on. The next day I need to have it off anyway. Like that. But phone never rings. Good technology. So anyway, I'm kidding. You can call me. Better to text me though. Those of you who become finance and accounting majors, please. That's the way to get a hold of us. Well, at least me. Anyway, we know what's value is, don't we, at any time? Would it make sense then if I have investments in other companies to record on my balance sheet, right? Recognize on my balance sheet the value. As soon as I know what it is. Of course, why would you leave it at historical cost? So everybody agreed we should do that. Here's the problem. Couldn't get agreement on what to do with the gain or loss. When is it a gain? When the value increases. Well, not sell it. We're not selling it. We're keeping it. We're holding it. It's an unrealized gain. That's a good point. I recognize the gain even though I haven't realized it. Wow. Because I'm going to increase its value if it goes up, right, on the balance sheet. I'm going to reduce it on the balance sheet if it goes down. Well, what do I have if it goes up? Obviously, a gain. But it'll be an unrealized one, not a realized one. Same thing on the loss. If it goes down in value, right, I have a loss. And all I'm going to do if it goes up in value is debit the asset account, credit a gain, huh? All I'm going to do if it goes down is credit the asset account, right, the investment, and debit a loss. You guys know about gains and losses from doing equipment, don't you, and buildings and stuff. Okay, same deal. Okay? But people couldn't agree to put that on their income statement because they didn't want to see all these gains and losses hitting the income statement. You can imagine why. Think about when the stock market 8 years ago went down by 50%. What would happen to companies' income statements if they showed those losses in their income statement? Holy cow, it'd be a disaster, right? So they don't want to show all that variability because that's how we measure how risky a company is, how variable their income is. So there's a lot of politics involved in this. So at first what they were going to do is they're going to make the non-current ones, the long-term ones, not be on the income statement, go directly to equity is what we do. I'll show you that before we're done today. Okay, go directly to equity, called other comprehensive income. And then the current ones, all the current ones, they were going to hit the income statement with it and run through a loss on the income statement or a gain on the income statement, whichever it is, and then go to retained earnings, right? And people still didn't like it. So they came up with this compromise. Let's have trading securities. So then the ones that are available to sell short term still go to other comprehensive income, an equity account directly. Don't hit the income statement. Then we'll put them in trading securities, right? The gain and loss in the income statement will only be in trading securities. And everybody goes, well, trading securities will be 3 months or 6 months. Not enough. It works down to a couple weeks only. And then what happened is most companies just decide they're going to hold their stock more than a few weeks, so it's not a trading security. So how do they classify it? Available for sale short term, and the gains or losses do not hit their income statement. So you'll rarely see trading securities in companies' financial statements, but you need to know what this stuff is, okay? Most of you guys are not going to be accountants, right? I'm really convinced you're not going to be an accountant, a lot of it. Okay, so I'm not going to do it, right? But, you know, and people find out. Taking a class like this, you find out if you're into this stuff or not, right? That's fine. It's good. Okay, decide what you want to do. But if you're not going to be an accountant, it's important for you to know what this stuff is. Oh man, yeah, and this is your shot, guys. So it's not just about fulfill a requirement for Keith, right? None of it's about fulfill a requirement for Keith. You want to know this stuff. You want to know this stuff. You want to know this stuff, and you want to keep it and take it with you. You'll have a huge advantage out there in the workplace. If you're in marketing or management or you name it, right? You have a big advantage. You're just doing your own investments. It's really valuable, okay? So get it either way. And certainly if you're going to do accounting and finance, it's going to be a world you live in, right? So, okay. Anyway, so we're going to use the market value method. We'll get in the journal just for that here in a second. Okay? Here, because we only have significant influence, right? We're going to call it an investment in affiliate. Okay, and we are going to use what's called the equity method, and we'll do this next time. Be sure to read about it. We're going to use the equity method here, and what that is I am going to record my share of their income as an increase in my investment, because I'm making that portion of their income happen. So if they have profit, I own 40% of the company. If they have profit, I made 40% of their income. If they have loss, I get 40% of their loss. Got the idea? What about dividends, though? Dividends under the equity method, I gave myself a dividend. Dividends under the market value method, I got dividend income. I'm going to record them differently. So the accounting's going to look a lot different with these. That's why it looks real confusing, huh? Okay, now on control, I'm going to consolidate. Okay, all this is going to be investment in subsidiaries. Major corporations, like Fortune 500 corporations, a lot of them own more than 200 other companies. And what they do is they consolidate all those companies. What does consolidation mean? You guys know what consolidate means anyway, don't you? Put together? Yeah. So here's the deal. The subsidiaries don't really exist. Only the parent does. So Yum Brands owns a whole bunch of other companies. The other companies do not really exist because Yum Brands runs them all. Got the idea? And what we want to do is we want to see the whole company. So we put them all together into one big company, right? So what you do is you add together all, if they own 200 exactly, be the parent and 200 subsidiaries, you'd add all 201 companies together. You'd add all their assets together, right? All their cash, accounts receivable, so on, right? All their assets added together. All their liabilities added together. Their equity kind of added together. Back a second. Their revenues all added together, their expenses all added together. Got the idea? One big financial statement. But here's the problem. There's a whole bunch of intercompany stuff. One company, the parent, owns the stock of all the subsidiaries, right? And the subsidiaries don't really exist, so we're going to eliminate all their equity. Except for the minority interest, the portion that's not owned by the parent, we'll have to account for that separately. So we'll do this next time too, and it's not in the chapters, so be sure to be here, right? I'll show you how to do this. What goes on in an elimination? The other thing, besides eliminating all the equity of the subsidiaries, it's going to go, right? Investment, the parent's investment in the subsidiaries is going to go too because it's an investment in yourself, right? Put the companies together. We're going to also eliminate any intercompany revenues. One company sells something to the other company. One has revenues, one has expenses. You got the idea? Eliminate it, doesn't exist. Okay, all the revenues, expenses, gains, losses in between the companies. We're going to eliminate any profit that's left in inventory of one company sold to the other company. This is a mess. I'm not going to make you guys do this. I'm describing what we're going to do in accounting 414. Okay, those of you who become a CPA, right? Could go all the way through the accounting. You're going to do this in 414. It's about half the class. It's just a mess. Okay, just a mess. Okay. One company sells another company, two subsidiaries, or the parent with the subsidiary, right? One sells another one an asset, equipment or building, and they sell it for a profit. Well, there's no such thing as that profit. And then they depreciate it over the years. You have to adjust retained earnings even for the combined companies and adjust all that depreciation out. It's just a mess, okay? But I want you to see what the picture is, that we're putting them all together. So when you look at a consolidated financial statement, what's going on? You put the companies together. You eliminate the equity, right? Of subsidiaries, you record the minority interest, and then so you'll know what minority interest is, and you eliminate all the intercompany activity. By the way, one company has a receivable, right? Parent maybe has a receivable from the subsidiary. Subsidiary has a payable. That doesn't exist. They owe the money to themselves. You have to eliminate that too. No payable, no receivable. Oh, you got to eliminate that too. You get the idea? It's a big job. I had when I was first teaching, the first year I taught advanced accounting because they always make the new guys do that. Nobody wants to teach it. And also you have a whole bunch of seniors and they don't care anymore, right? They're all good at learning. They're learning it anyway, you know, they don't care about you and they don't care about the class. They just want to get out and do their job and stuff. So you're trying to keep them motivated. Anyway, so I taught this fellow, he was a good student. And he goes through and he got a job with a big 4 firm, big 6 in those days. Anyway, he got a job. And about 5 years later, he sent me an email. He says, Keith, I want to thank you for making me learn that crap that we did in advanced accounting about consolidations. He was in charge of doing the consolidations, a manager now at a big CPA firm. He was in charge of doing the consolidation for a Fortune 500 company that had over 300 subsidiaries. He says, it's just unbelievable, what a mess. We've got, imagine putting together 300 companies into one financial statement. He said, I'm so glad I had a clue. And he says, I even pulled out my old advanced book, I still have it, and read about it again. It starts doing it. So anyway, it's real, you guys, so we do this stuff. All right, so let's do the accounting. We'll start with just this one, okay? let's do where we have no control. We're going to have trading securities available for sale, short-term available for sale, long-term. This is going to be the market value method, okay? We'll do the other ones next time. So here we go. What happened? That's weird looking, isn't it? What do you do? Ooh. That's a little strange, isn't it? Give me a new screen, please. I know what you do. Let's try it this way. Ta-da. We got a new screen. Okay. I must have hit something.
This is celebrating recording.
Or it went crazy. What's that?
Celebrating recording.
Yeah, I know. Well, isn't it nice when I use one sheet for the entire class? Just one big mass sitting over there. That one's gone. Yeah, so I hope it's not really gone for the recording. All right, anyway. The other class worked out anyway, I think. So if you want to watch it again. Okay, anyway. Let's do trading securities. Okay. Available for sale, short term, and available for sale, long term. Now, what do I mean by trading securities? And all these, what do I mean? I own what? One share up to, rule of thumb, 20%, right, of the common stock, or any preferred stock or any bonds, okay? How much control do I have? No control. So what method am I going to use? Market value method. Okay, there we go. Which means I'm going to adjust the market. That's it. I'm taking what the market gives me. So trading security, available for sale short term, available for sale long term. Okay? So let's say that we have a company, XYZ company. They have 1 million shares of outstanding stock. You know what that means, right? 1 million shares of outstanding common stock. Right? Everybody good? Glad you know what that means.
Can you say that again? 1 million?
1 million shares, outstanding common stock. Okay? XYZ company. We're buying some, right? We're buying some of the stock. Let's say we buy 1,000 shares. What portion of this company do you own? 1/1,000th, right? Well below 20%. What method are we going to use? Market value method, right? No control. We don't have any control. We only own 1,000. Let's say at the date we buy it, on the purchase date, the market value is $10. Okay? I'm going to buy 1,000 shares. Let's record the journal entry under each of these scenarios. Okay? What does trading security mean? I'm going to hold it for less than a few weeks, huh? What does available for sale mean? I'm going to hold those shares for more than a few weeks up to a year. What does available for sale? That's short term. What's available for sale long term mean? Hold it for more than a year. That's it, right? That's it. Okay? All right, so we know what we're going to do. How much should I pay for this stock? You know, $10 a share, 1,000 shares? 10,000. What did I give them? Cash. What do you want to credit? Every single one of these. Here's the purchase, all the way across. Let's do the purchase. This is too easy. Credit cash, $10,000. And it is easy. You know how to buy an investment. Credit cash, $10,000. Credit cash, $10,000. So figuring out what category they go in is the hard part. Recording the entry, big deal. We're going to call it investment in something, of course, because that's what it is. Just like investment in held-to-maturity bonds was investment in held-to-maturity bonds. This is an investment in a what, everybody? Trading securities. $10,000. That's a debit, okay? Everybody got it? This is too easy. Guess what this one's going to be? Investment in what? Available for sale. Short term. How much? Short term. $10,000. Even I could do this. Okay? And the last one?
That's in available for sale long term.
Okay. So what are you going to have to decide when you get up to these problems? Long term. Whoops, long term.
How long are you holding it?
How long are you holding it? That's it. If you know that, then I'll tell you the problem. If you know that, you got it made, don't you? Just screw up. Obviously, that's a credit, okay? All right? Everybody good? You can do those, couldn't you? This is just not hard. Okay, now let's say it's the end of the year, okay? So here we are, end of year. And we do this every year, but I'll just have you do one, okay? Let's say the market value is now $11 per share. What happened to me? I bought it for 10, it went up to 11, what happened? I gained $1 a share. Everybody agree? Stock's not worth 10,000 anymore, what's it worth? 11,000, right? 11 a share, 2,000 shares. No, I didn't get any cash, I'm not selling it. I'm holding it. I want to increase the investment, and I want to record a gain. What if it goes down in value? Let's say it was $8 a share. If I lose $2 a share, I want to reduce the investment with the credit, right? And debit a loss. There's no cash until I sell it. Okay? All right, then what else might happen? Let's say they report net income. Net income is $250,000. Okay? That's nice. Did I make the net income happen? No. If I'm using the equity method as affiliate, I made it happen. I made my share of it happen. Here I didn't make it happen. Somebody else is running it. I'm just taking what the market gives me. So what I care about is the change in market value. This I like because it probably caused the market value to go up, right? But I didn't make it happen. This is a market value method. And then let's say they declare a dividend. And the dividends, they made $250. Let's make the dividends $100,000. Okay? This one is going to be money I get. I don't get the whole 100, of course. How many shares do I own? 1,000. How many shares are there? 1 million. How much does each share get? 1 million into 100,000 is how much? 10 cents. So what do I get? 10 cents times 1,000. I get $100. Everybody agree? That's what's going on here. Okay? Pretty straightforward, isn't it? So I want to do the really hard one first. Yeah.
Isn't it that the long-term investments don't get dividends?
Oh no, they get dividends. Sure they do. The ones that don't, the ones where we don't, everybody gets dividends. Even if you have a subsidiary, they still pay you the dividend. You're just paying yourself the cash. As an affiliate, you still get the cash. You just don't call it a dividend, right? It's a reduction of your investment because you decided to give yourself back some of your investment. Okay, so we'll get to that next time. So on each of these, yeah, it's going to be a dividend. So let's do the hard part first. Let's do the net income. What do you want to do when they report net income? Nope. That would be the affiliate. That would be if it's an affiliate. We have significant influence. That'd be the equity method. Now it could be that the market value is going to go up because I got net income, right? I hope that does happen, but it might not happen. Depends on what else is going on in the economy. What do I do in terms of journal entries? No entry. Why? I did not make the net income happen. It just happened. I have no control, you guys. It's hard in there somewhere. I have no control. All right? So, yeah, they got income, I'm glad. What I'm going to reflect, though, is what? No entry for that, no journal entry. What am I going to reflect? The dividends and the change in market value. Okay? So let's do the dividends next. Let's do the dividends next. Okay? What would a dividend look like? I am going to receive what? Cash. How much cash am I going to get? In every single case, how much cash am I going to get? $100. Okay, we already decided that, didn't we? This is not hard. And what am I going to credit, seeing as I'm just letting the market give me what it gives me, right? I invested and they gave me a dividend. I'm thrilled. I got the dividend, right? It is dividend what for me? I earned it. Dividend what? Not receivable. Receivable would be if they declared a dividend, right? They'd have a dividend payable. I'd have a dividend receivable, right? This is they paid it to me, so I debited cash. What do I credit? Dividend what? I earned it. Things I earned are called keys. When you sell something, I have sales what? Revenue. When I earn interest, I have interest what? Revenue. When I earn a dividend, I have dividend revenue. God, I'm such a failure. And you did so good on that last quiz too. How come it takes so long for this to gel and really make sense? You know, when you're sitting where you guys are, it's kind of like, God, Keith knows so much. I don't know anything. compared to people who graduated from here 10 or 15 years ago. They just kept going. I know this simple stuff still, big deal. Right? My life's simple. I don't know anything, you guys. You can pick up on little I know really fast here. Just let yourself do it, okay? And try to make it all fit together. And I know it's hard at first, right? It's kind of like, oh my God, I can't learn this fast. In K through 12, they took it easy on you, didn't they? That's okay. You're also learning to be a good person and, do all this stuff. You're developing your mental capacity and all that. Now we're using it, right? Now we're using it. You guys can do this. I know you can. Debit, cash, and credit. Dividend what? Either revenue or income. The terms are used interchangeably. You know what? It's really income because there's no expenses that go with it. But a lot of people use dividend revenue. I don't care. It's okay with me. It's just fine. I don't know what the author uses. Do they use dividend revenue or dividend income? Or investment income or some weird thing?
Investment income.
Investment income, I don't like that. Call it what it is. Dividend revenue would be better. Or dividend income. Do they call it dividend income? The dividends?
They call it dividend revenue.
Dividend revenue. Okay, good. All right. So there's the dividend. Everybody got it? What's the last piece we have to do?
Market value.
Market value. Okay. So this stock that I paid $10,000 for, what's it worth now, everybody?
$11 a share.
It's worth 11, which on 1,000 shares is worth 11,000. So I have a gain of what? 1,000. So I want to record a gain. But this is an unrealized gain. I didn't get the money, did I? What's realized versus unrealized? Unrealized gains and losses would be, I haven't got the cash yet. What's recognition? Recording the gain or loss is recognition, right? Recording anything in the balance sheet, income statement, either one, right? Assets, liabilities, equity. Recording it is recognizing it. Put it on the face of the statement, right? Recording it is recognizing it. What's realization? The money changed hands. So this is going to be an unrealized gain. Why? They haven't sold the stock, right? So we call it an unrealized gain. You got the idea? Unrealized gain. Or if the stock goes down in value, it is an unrealized loss. Gains have what? Debit or credit balance? Credit, of course, right? Increases income, right? Losses have debits. Good. You already know how to do that because we did equipment and stuff, didn't we? All right. So let's do this. This is going to be the change in market value, right? That's the other piece. The market value went up by, we decided, $1 a share on 1,000 shares. It's $1,000, isn't it? So what do you want to debit if it's an investment in a trading security? I don't want to show 10,000 on my balance sheet. I want to show 11. What do you want to debit? Investment in trading security. I'm not kidding. So it's simple, isn't it, after you know what you're doing here. So now it's 11,000 in that account. What are we going to credit? Unrealized gain on trading securities. Sound good? An unreal gain. I like this one. It's unreal. Okay, anyway. Unrealized gain. Trading securities. Now this is going to be really complex going across here. What do you want to reflect on your balance sheet if it's an available for sale short term? You got it on the books at 10,000. What do you want it to be at? 11, right? It's just that you're going to hold it for a different period of time. So what would you debit, guys? Investment in what? Yeah, available for sale short term. That's it. How much? 1,000. If it was a loss, you'd be crediting it, right? Reducing it. And what am I going to credit? Unrealized gain, no kidding. Unavailable for sale short term. There's a big difference, though, between this unrealized gain on a trading security and this unrealized gain on available for sale short term. Get to that in a second. Big difference. Okay, and we'll do one more. Get you guys out of here. Investment and available for sale. Long term. 1,000, right? Sure, it's the same all the way across. You're just increasing it to 11. Okay, and credit what, everybody? Unrealized gain.
Available.
Yeah. Available for sale. Long term. Okay. Now here's where things get kind of hairy. These unrealized gains are different than each other. The one on trading securities goes on the income statement. These two are going to go directly to equity. Okay? So here's another little white lie that I gave you. Remember I told you there were only 5 kinds of accounts and there turned out to be 10?
Correct.
But that was a nice lie because it wasn't as intimidating at the beginning, right? And besides, the contra accounts are kind of a piece of cake, aren't they? Right? So this is another one. There are not 2 types of equity, there are 3. Here's what it is. Which are the 2 that we already had?
Capital retained earnings.
Yes. This is called other comprehensive income. It's all the stuff you can't agree on where to put it. Everybody agreed that we really needed to adjust these investments in trading securities available for so short-term and available for so long-term. We needed to adjust to the market value because we knew the market value, right? Should do it. But nobody could agree on what to do with the gain or loss. So I already mentioned what happens when the stock market went down by 50%, you'd have a massive loss, wouldn't you? Okay, so what happens is people just decide that they're going to hold the investments longer than a few weeks, and it puts it into the available for sale short-term or available for sale long-term category. And what happens is if you have one hit the income statement, of course, that's going to go in here, right? A gain or loss on them, unrealized gain or loss is going to go into our net income and then into our retained earnings, isn't it? Nobody likes that. You know what all those gains and losses in there. It makes their income look like it's bouncing all over the place. They look more risky. Okay, later we're going to use that as a proxy for risk we say, in 211 and in the finance 315. Okay, weighted average cost of capital model. Okay, anyway, what happens with these though is they go straight into other comprehensive income. So when you look at an equity statement for a company, there's equity statements too that you look at in Chapter 5, right? When we look at an equity statement, there might be a huge loss or a huge gain sitting in other comprehensive income from stock holdings. If you want to know about that, you have to know to go there and look. It's not going to hit the income statement. You got it? So if you're investing in a company that's holding a whole bunch of stock that is now worthless, what would you think? Maybe I don't want to invest in them, even though it doesn't show in retained earnings. It shows in other comprehensive income. Got it? That's where this goes. So I'll see you guys next time. All I want you to know for my purposes is the one on trading securities is an income statement account, and the other 2 are equity accounts. Got it? For the available for sale, you'll be fine. We'll pick up there next time, David. Okay?